Welcome back, everybody, to another Multifamily Report. I'm your host, Travis Watts. I'm the Director of Investor Education here at Ashcroft Capital. In this episode, we are going to talk about the economic headwinds that multifamily apartments are facing. After all, it's not always good news out there. So in today's episode, we're going to cover the good, the bad, and the ugly. Starting out with number one, we have interest rates rising. We've been talking about this on nearly every episode of the show, but there are still more meetings to be had in the future where the Fed anticipates raising rates even further. So as rates increase, that makes the borrowing cost to potential buyers go up, which can affect the pricing of pre-existing multifamily apartments. So you may have to adjust your prices down to meet in the middle on a negotiation if you're looking to sell multifamily this year or moving into 2023. Number two is the uncertainty of the Fed. Are they going to raise and then hold and see what happens? Are they going to raise and then taper off rates because we go into a bad recession? Or are they just going to continue raising and raising and raising for the foreseeable future? Nobody knows. I don't think the Fed even knows at this point. So we're going to have to wait and see, but it creates a lot of volatility and uncertainty in all markets. Number three, we are already in a technical recession, which is 2 consecutive quarters of negative GDP growth as a country. So the question is, will we go into a bad recession? Will we go into a minor recession? And what is 2023 going to look like? Number four is that the yield curve inverted on October 5th, 2022. That is usually a historic indicator that we are, in fact, going into recession. You can see on your screen, historically, when the yield curve has inverted, what follows is a recession. Number five, interest rate caps have significantly increased in price compared to a year ago. What an interest rate cap is it's like an insurance policy, essentially, and it effectively stops your mortgage or interest rate from increasing any further. So this would be applicable to any operators in the space that are doing floating rate loans or adjustable rate loans. They might buy an interest rate cap so that if they bought the property at, say, a 4% loan, and interest rates are now 6, 7, 8 in the future, they're capped out effectively at, say, a 5% or a 6% loan. So those were really cheap policies, relatively speaking, in recent years as rates were trickling down and remaining low. And now that we're in this very aggressive interest rate hike environment, some of these have gone up 20 to 30x in price. So the takeaway there is if you're going to be investing or buying on your own multifamily this year or next year, you probably should have an interest rate cap if you don't have fixed rate debt. Make sure that the general partners are buying those, but also expect that the prices of those have significantly shot up. So, for example, if you're in a deal and they don't have, say, a couple $1 million in cash reserves to buy one if they need one, they may have to do a capital call, or they may have to pause distributions if there's not enough cash to cover it. Number six, banks are getting more conservative and they are tightening their lending standards. So they realize we're obviously in an interest rate rising environment. They're probably going to require that you have a rate cap if it's going to be an adjustable loan, or that it's going to be a fixed rate loan. Some lenders are requiring higher down payments or additional cash reserves before buying the property. Number seven, this is the last year of 100% bonus depreciation, and it is now going to start tapering off. I believe we have 100% depreciation this year, 80% next year, 60% the year after. So the tax advantages are slowly trickling away. They're still great tax advantages at large, but just know it's not going to be as lucrative as it's been over the past 5 years. Number eight, stocks are down, relatively speaking, 20 to 30%. Some stocks individually could be down 70, 80%. It's a really rough year in the stock market. And with so much volatility and uncertainty, it certainly has a certain correlation to the private markets, though it's not a one-to-one correlation. But when the major indexes are down by these amounts, it puts a lot of investors on the sidelines to wait and see. Number 9 is the Russia and Ukraine war continuing on. And when you shut down supply of oil production and demand stays relatively the same, at least in our country, that helps boost inflation, which is not a good thing. It's what the Fed is trying to tackle. So as long as that war continues on, we're probably going to see elevated inflation numbers. Hopefully still tapering down with the way interest rates are going, but supply and demand imbalance is creating major issues for the economy. And number 10, last but certainly not least, property taxes and insurance are continuing to go up in addition to wage growth, property staff, contractors, maintenance members. So, as I like to say, you can't have your cake and eat it too, right? Just because we're experiencing rapid rent growth, which is a positive, our expenses are also going up at the same time. All right, now let's pivot and talk about some of the good that's happening in this economic environment. And the first is that multifamily apartment fundamentals continue to stay strong. We're still seeing very rapid and strong rent bumps and rent growth. Value add business plans continue to work. The Sun Belt markets are still booming. Lots of people, lots of businesses needing safe workforce housing, which has been undersupplied since about the year 2000. Number 2, the inflation that we see this year, relatively speaking, 8-9% annualized year over year inflation, is helping to justify rent bumps in addition to the value add strategy that we implement. And the name of the game for multifamily apartments is getting that net operating income to increase. Number 3, consumers are in great shape and employment remains strong. Number 4, in the commercial real estate space at large, there has been a drastic shift away from mixed use and hospitality and into multifamily and industrial. Those are the top winners at this point. Number 5, when interest rates increase and prices adjust downward, that creates a unique opportunity to buy into multifamily at a slight discount. And if you look back at historics of when multifamily was hurt, we'll take the Great Recession, for example. Average Class B multifamily rents fell about $125 per month nationwide. And in less than 2 years, we were back into recovery. So if you're able to hold through this period and continue buying at slight discounts, this can be a very opportunistic time to invest in multifamily apartments. And last, we are in a renter nation. A lot of people have been priced out for years now. And now with interest rates ticking up, they're priced out even further from owning single family homes. And so as a result of that, they're looking to rent multifamily apartments. This goes for millennials as well as baby boomers who have been cashing out of some of their larger homes, downsizing into apartments. So by no means is this an all-inclusive list. There's many more topics that we could cover and discuss, but I wanted to just simplify and bullet point out some of the pros and cons to investing in multifamily here at the tail end of 2022, moving into 2023. Thank you so much for tuning in to Multifamily Report. I'm Travis Watts. If you ever have questions, want to learn more, or take a deeper dive, you can reach me at travis@ashcroftcapital.com. Have a great week, everyone.